Welcome to another in a continuing series of webinars hosted by Ray Lucia, Certified Financial Planner, each designed to provide you with strategies and solutions for your most important investment and financial planning challenges. Today we present an informative program that stresses the value of long-term care insurance and some of the important financial considerations when selecting a policy. Today, Ray will be joined by Lyn Rowe, CFP. Please make a note of Lyn's website and phone number if you'd like to reach her after the program to review your long-term care insurance options. To reach Lyn, you can go to iwantmyltc.com. That's iwantmyltc.com, or call her at 800-644-1128. You can also fill out the form you see on this page to request an appointment. Ray and Lyn will be joined today by Ken Herlihy, Senior Vice President at Genworth Financial, who will talk about the challenges of long-term care and potential solutions in his presentation, Winning in the Second Half. Thanks for joining us today. Now, here is your host, Ray Lucia, Certified Financial Planner.
Thanks, Roy. As you've learned from Roy, of course, we're focusing on something that's really, really important and something that's near and dear to my heart, I tell you, because I've really studied this for a number of years with a little help from my friends, and one of those friends is sitting next to me right now, Lyn Rowe, Certified Financial Planner. Hey, Lyn, how you doing?
Good afternoon, Ray.
It's good to have you once again on the program. We've done this on the air several times, but it's never really, well, I should say it's so critical that we talk about long-term care, because what we're learning every single day, and it doesn't matter which study that you learn this from, because there have now been dozens of them, post-retirement health care costs are going through the ceiling. And one of those main costs is really something that's kind of good and kind of bad in a way. The kind of good part is we're living longer and longer. And the kind of bad part is we're living longer and longer, but sometimes it's not on the golf course or having fun. It's in a nursing home or needing home health care. Can you talk about that?
Well, you're absolutely right, and this is one of the reasons we talk about it so much, is because a lot of the clients that I am talking to, not only are they seeing family members and friends experiencing needs for long-term care, but it seems to be a continuing issue. And with my clients, we're seeing a lot of claims these days.
Well, it's unfortunate, but you know, if you have insurance, the claims aren't as painful. And if you don't have insurance, the claims can be exceptionally painful. And I've said this many times before. My wife, who actually was the ultimate deciding factor in us getting long-term care insurance, has said to me on more than one occasion, Lyn, it's the best investment we've ever made. Now, how can she say that?
Because, Ray, if you use that long-term care, it will be the best investment you ever made. And frankly, it will be the best investment both from a personal standpoint and a financial standpoint, because it gives peace of mind to the family.
I think you just hit it on the head.
Yes. Peace
of mind. One of the things, and I'm 63 right now, so I'm getting up there in age. Lyn's in her 30s or 40s. We won't talk about that, right? No. But as you begin to age, you start to appreciate more and more how financial security plays far more an important role than wealth creation. So by the time you're like my age, you've gone through the wealth creation thing for the most part. Now it's wealth preservation and really long-term financial security. And having a little pot of money in a long-term care insurance policy, I think, is the reason why Jeannie feels so secure in knowing that we will not be a burden to our children.
Exactly. Well, and it's also just giving the peace of mind that she can have help and do quality care if you need the care, or she can have quality care. I mean, quality is about what we're talking about as well.
Well, you know that if she needs the care, it isn't going to be quality if I'm doing it. So having, and I forget how much we have each month, is probably, what you know what I have? It's probably up to a couple hundred dollars a day in daily benefits.
Right.
And we're going to talk a lot about structure and strategy today with long-term care, right?
And a written plan of care. A written plan of care. That's going to be the key, I think, to a lot of this, because we've talked for years about doing a written financial plan. Why would you not have a written plan for your long-term care?
Well, you have a special guest in studio. Why don't you introduce our guest who's going to sort of walk us through this?
Exactly right. Ken Herlihy is here from Genworth. He is the Regional Vice President of Genworth. He's been in the long-term care business 27 years, so I think he knows quite a bit about long-term care and can lend a lot of good information to this discussion. So Ken, would you like to take it from here?
Lynn, thank you very much for having me today. I appreciate it. Ray, thank you for inviting me to share a presentation on long-term care planning and some of the things that we need to think about as we grow older and long-term care. So it's all about winning in the second half. And what is winning in the second half? Well, it's retirement. And now that we're at a time in our life that we're planning our retirement, a critical component of it is to think about long-term care. So as our friend Tom Landry once said, there we go, is setting a goal is not the main thing. It's deciding how you'll go about achieving it and staying with that plan. So very important things to think about when we're building that plan for our retirement and all the different components, and one of it being long-term care planning. So as we think about long-term care planning and winning in the second half, what's the biggest concern that most people have on their mind as it relates to long-term care? Well, what they're most concerned about is the cost of health care, and one of those costs being long-term care. And that's what we're going to talk about today, is the cost of long-term care. And one of the things that you'll find is people are living much older and longer than they did 10 years ago, 20 years ago, 50 years ago, 100 years ago. So we have to plan to think about living into our 80s and into our 90s. I personally have an aunt that's 99 years old, receiving some long-term care at home, which is where most people want to receive long-term care. She's receiving 24-hour-a-day home health care, but she's living a great life, living at home and being able to go out and do the things that she likes to do at 99 years old. So we have to think about what is long-term care, how can we plan for the future so we can enjoy the second half of our life. So now when we think about planning for the extended health care, what does that really mean? Well, planning for extended health care, first one is that we see that the average time that we'll see people once they turn age 65 that come down with Alzheimer's disease will actually use some long-term care for anywhere from 4 to 8 years on average. In addition to that, 2 out of 3 people over age 65 will need some form of long-term care at some point in their lifetime. And in fact, when we look at how long people use long-term care based on Genworth's extensive claims payment history, we know that those that receive care for longer than 12 months, on average, will receive some form of long-term care for about 3.9 years. So it can be a long time that people will receive long-term care. But keep in mind, it's not always in a nursing home or an assisted living facility. In fact, most long-term care is actually given at home. So that's what we really want to talk about today, is home health care.
Ken, can you break out the percentages you and I talked about earlier? You said home care versus skilled nursing, that kind of thing?
Sure. We see at Genworth that greater than 70% of our claims are actually paid to people while they're receiving care at home. About 15% of those people will receive care in a nursing home, and the other 15 or so percent, give or take a few percentage points, will receive the care in an assisted living facility. But without question, the greatest place that we see people receiving the most amount of care is at home. That's where people are receiving home care, or receiving long-term care for the most part today, is at home. So it's not about just going to a nursing home or just going to an assisted living facility. People want to be able to stay at home, and they are able to stay at home with more and more services available throughout the community today than we've ever had in the past. So
Ken,
home
let me
care.
ask you a question about that. Now, caregiving at home. Can anybody be a caregiver? Will the money come to that? Let's say it's a spouse that's doing the caregiving. How do you determine if they're qualified to actually give the care that's being given at home?
Well, there's lots of things that we can look at when we see long-term care happening both at home and in a long-term care facility. But when we look at home care, one of the components of a good long-term care policy, for example, in receiving home care is care coordination. And that's where a geriatric nurse will come into your home and build a plan of care for you and actually help you determine, you and your family, how are you going to receive this care, who's going to provide this care for you, and all the different care providers. There's lots of free services within a community. There's a limited amount of services that might be available through Medicare, but mostly in the private sector. What's nice about these geriatric nurses, they live in our communities. And they know who the good home health care providers are from maybe those that maybe you not want to use. They also know who can specialize in different types of care. So if you, Ray, for example, had a family member that needed care for a member of the family that had Alzheimer's disease, they're going to be able to recommend facilities, home health care agencies or independent care providers that maybe specialize in those people that need care because of Alzheimer's disease. So they really can get down to finding the right person or people or services from different entities that can come into your home and really make sure that you have all the right care that you need from all the different types of services, both professional care providers and even non-professional care providers, because we see a lot of people today that need care, and some of the things that they might need is meal preparation, for example. Well, you don't need to pay a nurse to come in and prepare meals for you, but you do need somebody that understands what maybe you have any special dietary needs, and they come in and prepare the correct meal for you at the right time of day, and maybe you even need some assistance in actually taking that nutrition in by being fed. And so they can do those types of things. And that's where these care coordinators can really look at the big picture for you and make sure they get all the different facets of the people that you need for you throughout the day, throughout the week, throughout the month, so you can stay safely at home. Because that's really what it's all about. You want to be able to stay safely at home. If I look at back to my aunt who's 99 years old, she has 24-hour-a-day care. She doesn't need a lot of care. What really she needs the person there for is to make sure that if and when she does need to use the restroom, for example, somebody can help her get there, because she's not always the steadiest on her feet as she once was when she was a little younger.
So more like standby assistance.
Standby assistance is very often some of the things that people will need, and the policy will pay for somebody to come in and help them with those types of things as well, not just always hands-on.
So my question is, if that standby assistance is a family member, does a long-term care insurance policy provide the income to that family member?
Yeah, in most cases, most of the policies out there do not provide paid services for family members. Some of the policies out there, they do have benefits that are available. They will pay for family members. Others will say that in order for a family member to be paid for, they have to work through a home health care agency, and then they would then pay for a family member. What we find, though, in many cases, it's not easy taking care of a family member.
No,
we all want to do that, but the reality is we're going to want to have somebody come in from the outside to provide that care for mom or dad. Where the family member is really most important is being able to provide more of the emotional, supportive help for that client versus actually providing the long-term care.
And Ray, one of the things I tell clients is if you're getting a professional caregiver and you've got them coming in 8 to 10 hours a day, you still have 2 shifts to cover at night. So you're still going to be working at night when the caregivers go home. So a lot of times they will actually train you to provide that care so you can help somebody get in and out of bed without messing up your back, and help them get in and out of the bathroom without, risking dropping somebody. I mean, that's the kind of training that they can do too.
Pretty complicated stuff, long-term health care. Back to Ken.
Great, thank you. And Lynn, back to your point about the caregiver training. That is something that, to Lynn's point, think about if you've ever seen, maybe you've seen it on a television show, or maybe you've actually seen it live and in person in a hospital. The nurse comes in and changes the sheets on the bed without the person ever getting out of bed. They do it while the person's actually lying in bed. Now, there is a technique to do it. I don't know how to do it, But I know that if a nurse could teach me how to do it, I'd be more than happy to provide that service to my parents or to my spouse or to whoever in my family might need that. So many of the policies will provide benefits for caregiver training. So it's to help that free caregiver, such as a spouse, teach them maybe how to do something that they say, well, why do I really need to have somebody come into my home just to change the sheets on my wife's bed? If I knew how to properly turn her in the bed and change the sheets, I'd be more than happy to do it myself. So that is a nice benefit that most long-term care policies have, and just makes it easier for the family when they have that skill and that ability to do that type of thing for the family member. So back to my slides, if I take you through what are the costs of long-term care? You know, the cost of long-term care continues to go up. And the cost of long-term care throughout the country, these are some national averages of what you'll see the costs of long-term care are. And if we look at what the costs are going to be in just 15 years, we see that for home health care, we're looking at greater than $90,000 a year. For assisted living, over $82,000 a year. And for nursing home care, $168,000 a year. So it can be a quite expensive proposition to have to endure the cost of long-term care. Now, one of the things that my company does at Genworth Financial is we every year for the last 10 years have conducted a cost of care survey. Now, this is a great tool for you when you're looking at what the costs are of long-term care. You can actually go to this map and you can select over 460 different locations throughout the country of what the actual cost of long-term care is. And where this is very important is, think about this. Today you might be living, we'll just use San Diego, California, but maybe you originally lived in Tuscaloosa, Alabama, and you say, you know, I'm going to move back home when I retire. Well, we want to make sure that when we look at long-term care planning, we're not just thinking about what the costs are in San Diego, but also what the costs are in Tuscaloosa, Alabama. Now, I know the cost in Tuscaloosa is a little bit lower, so if I were to plan for San Diego, I'm going to be just fine. But what if that person says, no, I'm not moving from San Diego to Tuscaloosa, I'm actually moving to Midtown Manhattan? Well, one thing I can promise you is the cost in Midtown Manhattan is quite a bit more expensive than San Diego, California. So I'd want to adjust my plan to ensure that when I get to Midtown Manhattan, I've got the right funds available, not just to pay for California, but to also pay where I'm ultimately going to retire in Midtown Manhattan. So a great tool and a great resource to use, the Genworth Cost of Care Survey, to look at what the actual costs are of long-term care. You can also use this tool to project what the costs will be in 5, 10, 15, and 20 years, so you can see what the costs will be in the future, not just what the costs are today for long-term care. So a great tool to help you with that. So the next thing is we want to avoid the risk. And when we think about people over age 65, we know that 2 out of 3 people will need some form of long-term care. So the next thing is we need to look at, well, maybe we want to assume the risk. And that means really self-insuring and what those costs are. How are we going to pay for that risk? What dollars are we going to use? Well, most people say, well, I'll cash in some CDs, some money markets, maybe my stock portfolio. It could be the house that I have up at the lake. Those are the different assets that they're going to use to pay for their long-term care. We have to think about what the costs are going to be in the future. And what those costs are going to be is, and how inflation is going to take a toll on your portfolio for the cost of long-term care. So take a client with $2 million in their portfolio to pay for long-term care in retirement, and after 30 years that money has grown to about $2.5 million. Well, how is that long-term care cost going to impact them? With the market providing an average rate of return of about 9%, that gets us to our $2.5 million. But what happens when there's a long-term care event? And that long-term care event starts to erode at those clients' dollars. Now you're going to see the dollars eating away very quickly. When we know that the average cost of long-term care today is about $44,000 for $90,000 a year for 44 hours of home care. it is quite expensive, and the costs are just going to continue to rise. So we could see a client really eating up much of their portfolio in a very quick time manner. As I mentioned earlier, the average stay for a long-term care event is about 3.9 years for those people that need care longer than 12 months. So it can become quite expensive and can really erode our entire portfolio in a very short period of time. So we have to keep that in mind. So the last one is we can transfer the risk. There's really two ways we can transfer the risk. There's two types of long-term care insurance policies out there today. One is a policy that is a life insurance policy that has a long-term care rider. And that allows the client to have some long-term care benefits through a life insurance policy, and if they never use the long-term care benefits within this policy, when they pass away, there's a death benefit paid out to their family. And then there's traditional long-term care insurance, which is just that. It pays for a long-term care event as you grow older, when you need long-term care, whether it's for home health care, for assisted living, or for nursing home care. So that's one of the two ways that you can transfer the risk. But the bottom line of all of this, it's all about a plan. And that's what we need to talk about today is what is your written plan? Everyone should have a written plan for long-term care. Once you have that written plan, we need to talk about how are we going to pay for it? What assets are you going to use? Are you going to use insurance? What is the solution for you with this plan?
Can you give us some examples of a plan like that, Ken?
Sure. There's actually 5 ways that you can handle the written plan for long-term care. The first one is for those people that say, I can self-insure. And if you're going to self-insure, then we need to look at all the assets that you have and determine what of those assets and how you're going to spend them to pay for your long-term care. Think about this, Lynn. If you had a client that was a single woman, for example, and she becomes incapacitated, and now the children are responsible for handling her financial affairs. And let's say that that gal has a CD at 2 major institutions, and the kids go and cash in the wrong CD first. She would have rather it been at Bank B versus Bank A. So putting it in writing and will help the children know exactly how mom wants that money spent. So we need to write down, if we're going to self-insure, how we're going to spend that money, in what fashion, what's going to be spent first, then second, third, and so on. So we make sure we spend the money the way mom's wishes would be if she was able to handle her own financial affairs. The second way is we can look at the government's welfare system. Most people call it Medi-Cal, Medicaid. California, we call it Medi-Cal. Outside of California, we call it Medicaid. The bottom line, it's the government's welfare system. How do we become eligible for the government's welfare system? Well, we have to spend down the assets that we do have down to the poverty level. Really not the greatest choice for most people, but unfortunately we do see a lot of people that are forced to rely on the government's welfare system because they do run through all the assets that they have, and now they have no other choice but to go on the government's welfare system for long-term care. Probably the most important thing to recognize there when you're going to use the government's welfare system is that you're not going to receive home health care in most cases. Most long-term care that's paid for by the government is going to be provided in a nursing home. So if your client's concerned about home health care, option 2 probably isn't the best option for them of going on the government's welfare system.
And today, isn't it true that about 70% of the claims are being paid by welfare?
That is true, about 70%.
And I would venture to say that most of those people did not plan to be on welfare. They just didn't take into account the cost of the care or how long they'd be on care or something along those lines, and didn't plan.
Lynn, you're absolutely right. That's exactly what happens is it caught them off guard. They didn't have a plan. They weren't prepared for this situation. Or in some cases, they believed that they had enough money to pay for their long-term care, not knowing what the actual costs are, and then finding out the hard way that their money ran out much quicker than they ever thought it was going to, and their only solution was to rely on the government's Medicaid program. Now, the third way to pay for a long-term care event would be through private long-term care insurance. So having a private long-term care insurance policy that would pay for your long-term care, whether it's at home, in an assisted living facility, or in a nursing home. Policies will pay for all three types of care. The fourth way is what we refer to as linked benefit policies or hybrid policies. These are life insurance policies that have a long-term care rider attached to them. You can use them for long-term care, but if you don't use them for long-term care, they're still available for you in the way of a death benefit for your family when you pass away.
Now, Ken, I've been intrigued by these policies for a number of years, as you know, because you were involved somewhat in helping me get my own long-term care insurance some years back. The fact is, I did look at these, and they're very, very attractive for several individuals, in particular those that have a bunch of money sitting in the bank, and I dare say today, not earning anything. So can you explain how this might work to one's advantage if they're sitting on cash?
Sure. Really the advantage of somebody that is a self-insurer, somebody that's saying, you know, I've got money in the bank, I'm going to take care of this long-term care event myself. Well, let's just take somebody that has a $100,000 CD, for example, in the bank today. Now, we all know CD rates aren't paying the highest amounts as we've seen in other years. Let's be generous and say they're earning 1%. So they're going to make about $1,000 a year on that CD. I could transfer this $100,000 to a linked benefit life insurance policy with long-term care. And the leverage that you'll see from these policies, generally speaking, will be somewhere around that $100,000 to about a $200,000 death benefit and about a $600,000 long-term care benefit paid out over a 6-year period of time.
Excuse me, I'm sorry, I need to interrupt you. So if I get this right, I put $100,000 in the long-term care bank. If I died a year later, my heirs would get $200,000 in life insurance proceeds. I presume that's tax-free since it's life insurance benefits, correct?
Correct.
Okay. And you're saying that I would get $600,000, is that for a husband and a wife?
No, that'd be just for one person.
So I have $600,000 of benefits that you'll pay out at about $100,000 a year over the next 6 years. Wow.
That is correct. Yeah, it's a great way to look at an alternative other than traditional long-term care insurance. In fact, one of the things that we also see, about a fourth of the people that buy these hybrid linked benefit life insurance long-term care policies is folks that have maybe bought some have an older life insurance policy that they bought 20, 30, 40 years ago. Their needs have changed. They bought it when they had small children. The kids are now grown, out of the house. They're done with college. They've paid their house off. Their life insurance needs might be different than they were in the past, and they have some cash buildup in these policies. Rather than cashing them in and having the tax implication, they look at doing what we refer to a 1035 exchange. And now we put it into these hybrid policies, and you didn't have any tax implication on this long-term care life insurance policy, and it's a great use of those dollars rather than having to pay to Uncle Sam.
Now, Ken, people that have money sitting in a CD sometimes have that money there for emergencies. Maybe it's not the whole 100,000, but maybe they need to get their hands on 10, 20, 30,000 bucks. So what do you do about that?
Yeah, so a couple things. One is most of these policies have loan provisions, so there are ways that you can actually take a loan from the policy. So that's one thing. The other is we've even seen people that say, you know, I've got this $100,000. I'm concerned I might need some of that money at some point. And so sometimes they'll split it up into two policies. They might buy two policies for $50,000, leave one totally intact, and cash out the other. The other thing that's really nice about these policies, they have provisions where you can get your money back. In fact, get all of your money back. Some of them in the first 15 years, some of them for the life of the policy. At any time you can say, I don't need this policy anymore. I just want my money back. And there's a provision in the policy to, in fact, do that.
Okay, let me see if I understand this, because I'm a little slow on the uptake. These are a little bit better than the ones I looked at some years ago. I think, anyway. I can't remember that one being the one I had having that much long-term care insurance associated with it. But if I understand what you just said, and please correct me if I'm wrong, I put $100,000 in. I'm insured for $600,000 at $100,000 a year for 6 years. So if I go into some Alzheimer's unit, I've got $100,000 of long-term care insurance for the next 6 years. 6 years later, there's some miraculous cure for Alzheimer's, and I say, or I don't have any kind of an ailment after 6 years. I want my money back after 10 years. I put that money in a CD. You said I was getting $1,000 a year, so I gave up $10,000 for 10 years worth of coverage for $600,000, and you'd give me all my money back.
Yeah, if you didn't, assuming you didn't use any of those dollars for long-term care, and you had that policy for 10 years, and at the end of 10 years you said, you know what, I just want my money back, we absolutely would write you a check for your $100,000 back.
And that's true if it's 1 year, 5 years, 10 years, 15 years?
That's correct.
Pretty amazing.
Yeah, it truly is a nice way to look at another alternative to building a long-term care plan. The last way to build a long-term care plan, and this is one that so often people don't think about. When they think about insurance or they think about paying for it out of their own pocket, they think that it's all or nothing. And on long-term care planning, it can really be a combination. There's nothing saying that you can't have a long-term care policy along with using some of your own money. So a combination of 1 and 3, or a combination of number 1 and number 4. Number 4 being a life insurance policy with a long-term care rider, along with using some of your own personal income. So a lot of people will look at, how can I do some mixing and matching? Nobody said you had to buy long-term care insurance that covers 100% of the cost of a long-term care event. If you're able to do some self-insuring out of your monthly income, that's a great way to help bring the premium down on traditional long-term care insurance. Or if you're looking at a hybrid policy, not buying as big of a policy and keeping some of your money in the bank, or being able to go out and spend it because now you've got your long-term care covered and you don't have to worry about that rainy day with those dollars set aside for long-term care. So a combination of some self-insuring along with an insurance policy is another great way to build that long-term care plan, because that's really what it's all about. It's having a plan so when something happens, the family knows how to take care of you, because this is not about you. This is absolutely about the family. The family is critical in any time we have a family member needing long-term care. It's not about that one single person, it's about the entire family.
That's right, because the family is going to be affected. Now, Lyn, you and I were talking earlier about a technique that you use that I found fascinating, and I want you to tell our audience about it, because what you said, I think, was gobble up as much of this stuff as you can gobble up right now, because someday when the premiums go up, and they probably will go up someday, you can modify it. Talk about that.
Well, if you start out with a very skinny policy with not very much flexibility over time and those premiums go up, you haven't left yourself much wiggle room. But if you start out kind of over-anticipating, building up the cost of living adjustment and so forth, and having just enough padding in that policy that, say, 10 years from now when the premium goes up, you have the ability to back down a little bit and still have good benefits and get your premiums back down to a level where you're comfortable.
Now, Ken, we have noticed many companies across the United States with these fairly substantial premium hikes. Interestingly enough, my policy, I haven't seen a premium hike, and I've had it for 3 or 4 years now. So can you explain what's going on within the industry?
Sure. We've seen one of the things that's happening today is these incredibly low interest rates, and that's cutting into the returns that we're seeing on these policies to allow us to pay claims. And so, unfortunately, we have seen companies that are having to raise rates. That's one reason. We've also learned a lot. This is a newer industry. The long-term care industry has been around for not quite 40 years, and we're learning more and more about underwriting. And then probably the biggest one of all that has really affected the rate increases is people buy long-term care insurance, they never cancel their policies. In the early days of long-term care insurance, it was anticipated that we would have a much higher level of cancellations of active policies. In fact, people don't cancel their policies. Once a long-term care policy has been put in force, we only see about a 1% lapse in long-term care policies, which means the insurance company is seeing more claims than they originally anticipated, and therefore we've had some rate increases. But as we continue to learn more about the policies and the underwriting, we're going to see that the ability to price these products is going to be much stronger. But we will continue to see, I think, some rate increases over the years. I don't think they'll be as big on newer policies as they were in maybe some of the older policies. But you really should expect to have some rate increases over the years with your policy. And to Lyn's point, what we've seen with people when they do receive a rate increase is that many times that they reduce their coverage some, that they have more coverage than maybe they really needed, and they can reduce their coverage to keep the premium at the same level that it was prior to the rate increase.
Yeah, I think we should point out, Lyn, that the reason they might have more coverage is because they bought a cost of living rider or an adjustment. So like in my case, I think it was $216 of daily benefit. That's what it would cost. And I bought a $180 benefit, but now I'm over $220 of daily benefit. So I did get an increase. You could basically adjust my COLA going forward to hold my premiums down. Is that how you do it?
You can adjust the COLA, the benefit period, the daily benefit. I mean, there's a lot of variables that you can work with, and that's where I get calls from my clients who've had their policies for years who say, okay, my premium's gone up. Let's look at some alternatives. And so we do. We look at the alternatives together. But the other thing I like to point out is that when you see these rate increases, this has been my experience, that my clients, somewhere between the 11th and the 15th year is when they had their first rate increase. And those rate increases might have varied between, say, 10 to 40%. And 40 sounds high, but if you divide that by 11, it's nothing compared to what your health insurance did.
Well, that's absolutely right. Now, one of the other things I wanted to bring up, because you're out there in the field every single day talking with people, and one of the things that frustrates me, because I was part of it, I procrastinated getting my long-term care insurance policy. It had to be for almost a decade. And you know you need it, you know you want it, you figure, oh, I could move some stuff around and probably, if I really wanted to, afford it. How do you get people to act? Because we do know that we need this. Ken's already told us 2/3 of us are going to have a need for this. Imagine if 2/3 of us were going to have our houses burned down. How quickly we would run to our property and casualty broker.
Well, and the truth is the chances of a house burning down are somewhere between 8 and 10%.
That high? Wow.
That's on the high, yeah. So if that was the case, I mean, and yet if your fire insurance lapsed and your head hit the pillow that night, you would be panicked. You would be, the next morning, the first thing you do is call that company and get it reinstated. But the chances of, again, we've said this before, but the chances of you needing the long-term care is about 44%. The chances of my needing it is, 73%.
It's because you don't eat enough meatballs.
Well, there's that.
No, it's really because the females have higher morbidity. And you would never catch her eating a meatball anyway.
We were the caregivers all those years. Women took care of the kids.
Yep.
And they took care of the husband. Oftentimes they'll take care of the parents. They might take care of a sibling. They might take care of the in-laws. We kind of get worn out.
We, as in the women, kind of get worn out?
That would be we. That would be us.
This is not a sexist statement at all. But you are correct. So the odds are almost 50% that a male my age would end up in some kind of a facility or needing home health care.
Right.
And the odds are 70% if they're a female close to your age.
Yes. Well, and I have had three family members need care. All were at home, to Ken's point about where you get the care. All were at home, and 2 of the 3 were males. So we shouldn't assume that men don't need care. And that's a lot of times I hear couples, let's get the coverage for her. Well, let's face it, that means that you're assigning her the responsibility of taking care of you. We don't want to do that.
All right, it's a very, very important component of one's financial plan. There's no question about it. You really do have to get off the dime and almost force yourself to get this written plan. I'm quite interested in this written long-term care plan because I've been a big written plan guy all of my life, but I've never heard of a written long-term care plan before. Talk about that very quickly, if you will.
Well, and Ken brought this up earlier. It's basically, it's like doing the fire drill. You know, you need to stop and think about what assets would I want to liquidate first, and putting it in writing so that the family members or your friends or whoever you have assigned that responsibility to, know how to deal with your assets the way you want them dealt with. I mean, let's face it, if you had a long-term care need and it was, say, a couple of years, and you recovered and they had sold the wrong assets, that could damage your future going forward. So you want to make sure that you put it in writing, and also it helps between a husband and wife to just sit down and say, okay, if I need care, here's what I would like to do and here's what I think we should do with the assets. And the best advice you're going to get is from each other.
All right, that's Lyn Rowe, Certified Financial Planner. Her website, by the way, iwantmyltc.com. Lyn Rowe, CFP. iwantmyltc.com. 800-644-1128. Give Lyn a call and get your plan in writing. Well, Ken, final thoughts from you. You are the expert. You've been doing this. I can't believe you. Lyn said 27 years. You don't look old enough to have done it 27 years, but I'll take your word for it. But some final thoughts for our audience for today.
Yeah, I think the most important thing is this is all about the family. I've said it already, I'll say it again. Get together with Lyn, have that plan written, because you want to take care of your family. That's what's so important, is making sure that you have this plan in place, because you never know when something's going to happen. It could happen tomorrow, it could happen 25 years from now. But you want to be prepared for that event when it does happen, and you don't want to leave your family in a position where they just don't know where to turn. Having a written plan in place will give them the guidelines to say, this is what Dad wanted, this is what Mom wanted. We know how to execute the plan to ensure that Mom or Dad receive the best care that money can buy, and we know exactly how and where they want to receive this care. So it's all about that written plan of care.
Well, thank you, Ken Herlihy, and thank you, Lyn Rowe. That's right. You know, when we talk about things like insurance, it's always the other guy. You know, the other guy that dies early. It's the other guy that has his house burned down. It's the other guy that needs long-term care. Well, you're the other guy to me, and I think I'm the other guy to you, or lady for that matter. Lyn, again, thank you so much. You do a terrific job, Lyn Rowe, Certified Financial Planner. Go to Lyn's website right now, and at iwantmyltc.com. Get your written plan, get a proposal, nothing else. Find out how you might be able to manipulate the numbers for your own benefit, for your family, as Ken said. Or you can simply call her at 800-644-1128. That's 800-644-1128. I want to thank everybody for tuning in to our webinar, very, very important webinar on long-term care. Lyn Rowe, Ken Herlihy, and now back to Roy Robertson.
Thanks for joining us today for our continuing webinar series and today's presentation, Winning in the Second Half. As a reminder, you can contact Lyn Rowe, Certified Financial Planner, for a complimentary consultation to review your long-term care options, either by filling out the form you see on this page or by calling Lyn at 800-644-1128. And you can also visit her website, iwantmyltc.com. Thanks again for joining us today, and thanks to Ken Herlihy from Genworth Financial, Lyn Rowe, and to our host, Ray Lucia.